Good afternoon, everyone, and welcome to this month's Best Practices session. I think we're going to have some latecomers, as we normally do at this time, but I wanted to respect your time and start as early as possible. Today's lecture is presented by Zoe Adrian, an investment advisor with BMO Nesbitt Burns Inc. Zoe has a number of degrees. She has an engineering degree, a Bachelor of Education, and she has a Canadian Investment Manager designation. She works with small business owners and entrepreneurs regularly to help build and manage their wealth both within their corporations and personally. She conducts a number of educational workshops on a variety of financial and economics topics to professionals and business groups. So we were really delighted to have someone offer to come to MaRS that had a specific background and expertise on working with entrepreneurs and their special financial needs. So I'd like to welcome Zoe.
Well, thank you so much for having me, and I hope that today you'll come away with some valuable information and something that you can work with down the road. If you have questions at any point during the presentation, please don't hesitate to ask. I'm happy to talk about things as we go through it. Let me grab my... So today I'll move this along. So today we're going to cover a variety of topics. To begin with, we'll take a snapshot of where you might be at age 65. We'll talk a little bit about protecting your personal finances and not mixing them up with the business finances. Tax efficiency, nobody wants to pay the government more than their fair share. Risk and reward from the perspective of investing as an entrepreneur and how that should work for you. Retirement and succession planning, also known as your exit strategy, and how you should plan for that. Managing corporate assets, if you're fortunate enough to get a lump sum that you can use to grow your business. We'll talk about how to manage that if there's a period of time where you're not using it all. And then finally, planning for the unexpected. So let's take a look at 240-year-olds today, and if we fast forward them to age 65, where are they going to be, and how are they going to look from a financial perspective? So one man and one woman are going to be wealthy, which means that they don't have anything to worry about. The world's their oyster. 8 men, 2 women will be financially secure, which means that they can maintain the lifestyle that they've had all along. They don't have to worry about things, and they'll just continue on as if nothing happened. They didn't retire or anything. 14 men and 11 women are going to have to continue to work. And at this point, many people are choosing to work past that age, but these are the group that will have to continue to work because they are going to use that to maintain their lifestyle. Unfortunately, 24 of the men and 4 of the women won't have to worry about retirement planning because they won't be around at that point. So that makes their life simple from that perspective, but a tragedy. The shocking part here is that 53 men and 82 women are going to require financial assistance. So either from their spouse or the government or their kids, they're going to need extra money to keep going. They're going to have to keep working as well. And that's really kind of shocking. And what you're doing there is you're looking at the masses. It's not just a select few who don't have enough. This is the masses. So, it's a bit like the one guy talking to the other guy going, well, have you been putting away for retirement? No, I haven't been putting away for retirement. And the one guy feels better because his buddy hasn't been preparing either. So, it's a little bit like the buffalo as they stampede over the cliff. There's a significant number of people these days who are not prepared for retirement. So for you as an entrepreneur, you have no pension plan, so it's definitely something that you have to pay, especially you have to be mindful of your planning for that reason alone. So just starting off then, let's take a look at protecting your personal finances. And this is kind of the #1 mistake, and a really large mistake as you first start out, is that first of all, you don't pay yourself from the business. You think, well, I don't need that much to live on, and we'll have the business pay my mortgage, and you blur that line between your business and your personal finances. So number one, that's a terrible nightmare for you or your bookkeeper in terms of trying to keep track of everything. And secondly, if you get audited down the road, it's going to be way more of a nightmare for you. You don't even want to think about it in terms of people coming around trying to keep track, well, where did this come from? And you know, looking at things from that perspective. So from that alone, you need to try to, you know, pay yourself and use that pay for your personal expenses and so on. And that is a really important part of trying to keep things simple. Now, in terms of credit cards, this is not really my realm, but I thought I'd bring it up anyways. Something to keep note of is that if you have a small business credit card, it's not regulated by the same act as for your personal credit card. So your credit card company can do things to you from a business perspective with your credit card that they wouldn't be able to do from a personal standpoint. So an example of this would be, you know, if you're late or if any of your creditors report a late payment, not just your credit card company, but any of your creditors, your credit card company can actually jack up your interest rate from that alone. So that's something to keep in mind, that those regulations aren't quite the same, and you need to keep that straight. Another thing is, if something happens to your business and you start to have credit issues with that credit card, you know, there's sometimes a fuzzy line as to whose credit that's going to affect, and it may not just affect your business credit, it very may likely affect your credit as well. So just keep that in mind. Credit cards can be a bit tricky. I know people do use them at times when they're unable to get other financing, but you know, you want to be a little bit careful with that. Incorporating offers a layer of protection for you between you and your business, and that's a really good thing to do. If you get beyond that, at some point your accountant may also suggest that you have a holding company, which again offers another layer of protection between you and your corporation, and that's good from not just a creditor standpoint, but it's also a tax efficient way of working your business. Your accountant will be able to help you. That you know, it's really good to have an accountant that you can trust, and they'll be able to walk you through this and hopefully get the timing right and so on with those. On a personal level, you may also want to consider creditor-proof investing options. Segregated funds are like a mutual fund, but they're put out by an insurance company, so it's an insurance agreement that you're filling out when you do the segregated funds. So in fact, they are creditor proof, whereas a general mutual fund, if it's not in a registered account, would not be creditor proof. So you have options like that as well. Your RSP is now considered to be creditor proof other than your last 12 months of contributions. It hasn't been tested yet, but that's how it's meant to be at this point. So your RSP may be creditor proof, so in that case it wouldn't matter what, you know, whether you had mutual funds or whatever you put inside them. And a pension plan is also creditor proof. And you may think, well, a pension plan is for someone who works at a big company. You can do an individual pension plan for yourself as the owner of your corporation, and I'll talk about that later on. It's also a tax efficient way of working your business. Any questions on any of that? So as a business owner, you've spent a lot of effort putting some thought into your business plan. You've, I'm sure, worked it through, you've agonized over it, lost sleep over it, the whole bit. But what about your own personal plan? And isn't it worth spending a little bit of thought on that? It is something that people worry about. When you start to think about a personal plan, the first thing it's going to hinge on are your goals and aspirations. So things like your near-term goals might be to buy a house, might be to pay down the debt in 5 years for your mortgage. If you have kids, you're going to want to open some kind of an education fund for them. These are all kind of near-term goals. Your long-term goal may have to do with retirement. But in general, your goals give you the freedom to do things that you want to do. And so it's really important to think about those and then put a little bit of planning. You don't have to have a huge amount of planning. And in fact, that's where you want to delegate. And having an investment advisor who can help you with a plan is a really useful function. You know, you've got accountants and so on. You want to have surrounding you a group of financial advisors. And that's not necessarily an investment advisor, but people like your accountant, your lawyer who's going to help you through, and your investment advisor can help you with some of this planning. And that's really good to take part of. You know, they can draw up a plan, whether it's for the near-term goals or the far-term goals. And then you can enact it and implement that. Some of the services that can be offered by your investment advisor, it's a really wide range. So I think this is probably a little bit small. I'll walk you through it. On the left-hand column, you know, you've got family issues, your own personal security. You may have to help your parents along, and you may have kids that you want to pay for in terms of education and so on. Protecting your lifestyle includes things like insurance and disability insurance, and we'll talk about that as well. Investing is what you typically think of as your investment, that your investment advisor can do for you, but it's only one part of the main branch. Planning we just talked about, but also things like estate planning. So you may want to create a legacy somehow, either with an institution or just with your own family, and also philanthropy and giving back. So these are all things that your investment advisor should be able to do for you. They may not be relevant to you at this point, but at certain times in your life, some of these things will become more and more relevant. So getting to the meat of things. You need to have a saving strategy. And so what is considered to be a good saving strategy? Well, a rule of thumb is to save at least 10% of your net income. Now, quite frankly, what I see daily, basically, is you see a few different kinds of people coming through it kind of around the age 55 or 60. And some of those people have done the savings, and they kind of think that retirement might work out for them. And the other people who come through are the people who haven't been saving regularly. And they're worried and they're stressed, and with good reason, because if you haven't been putting money away, it doesn't matter, you know, what the markets are doing. If you haven't been putting the money away, you don't have that foundation to grow from. So having a saving strategy, to me, is the one biggest differentiator. And it seems like a simple thing. You know, your grandparents may have slipped you $5 as a kid and said, you know, put that away. It seems like a simple thing, but it's a really good habit to do. You want to do it automatically, and every year you want to try to increase that amount a little bit. So it's something that you want to review as kind of your overview, you know, every year, either the new year or the year end of your business. You want to overhaul things. This is a really good time to look and say, okay, can I save just a little bit more? The gold star is maximizing your RSP and tax-free savings account contributions in a year. How many people are doing that? Got a few, good. Gold stars for you. And if you have still money left over, if you are managing to maximize those areas and you still have a little bit left over, then there are some more options for you. We're going to look at that right now and see what accounts we can use. So we have a few different registered savings accounts, the tax-free savings account being the newest. And I'm just going to walk through a little bit because I get a lot of questions about this one. What you can do is contribute $5,000 every year. That'll start to increase with inflation, but for now it's $5,000 a year. It is post-tax dollars, so it's not something that you have to do before your taxes, you put away your taxes, because it is post-tax dollars, you don't get a tax credit for it. However, any growth in that account you can pull out at any time, or you can leave it in. Doesn't matter. If it grows, you don't have to pay taxes on it. So whether you leave it in your account to grow some more, or you withdraw it, there's no taxes being paid. Not only that, the following year or later, you can recontribute that amount plus that year's contribution. So it's a fairly flexible account in that way, and you can use it for a variety of different goals, but I would suggest that you put a goal to your tax-free savings account. So don't just kind of think of it as a savings account that you're going to, you know, maybe use here and there. Put a goal to it. So make it longer term. So if it may be retirement for some of you. I know people who have used it as an account to grow a down payment for a house or a cottage. But put some kind of a goal to it, because otherwise you won't find that you're getting the best value from it. RSPs, you do get a tax contributions. It is RSP season now. Please make your contribution before the 29th. Our ESPs, if you do have kids, they are a good idea. You get free money from the government for it, and you want to take advantage of it. Also, if you have a disabled child, you can open an RDSP, which is a fairly new account, and that also works with free grant money. So you want to take advantage of those registered savings accounts, and probably one of the most common questions is, which do I contribute to, my RSP or my tax-free savings account? And I get that often. So if your goals are both long-term for your tax-free savings account and your RSP, then you have to make a decision. And that's going to depend a little bit on how you get paid. So if you're early off in your business, you may be getting mostly a dividend income. So you may not have much of an RSP contribution room there at all. And you're not getting a huge amount of income to report on. So what I would suggest, What I would suggest is putting your funds into your tax-free savings account. So make that your #1 priority. If you have extra, you can throw some money into your RSP, but I would make the tax-free savings account your #1 priority. As you start to earn more and you start to earn more T4 income, now you're starting to get more money, you've got some more contribution room. Now I would change that priority and start to look more at putting money into your RSP and getting that tax credit. Having said that, if you have different goals, you may have different timelines and different priorities that may change things up altogether. So you have to kind of balance that through. But that's my suggestion to people. Now, in terms of non-registered savings, you probably wouldn't use a non-registered savings account until you've maxed out what you can with the registered accounts. Having said that, a whole life or a universal life plan isn't just something that you have to think about in terms of, well, if something happens to you, your beneficiaries will be able to have that lump sum. You can actually use that also as a savings account. And it can be a pretty good savings account and a low risk one for retirement as well. So that is something that you can use as a retirement tool. Anyone have any questions about any of the...
How does the whole life insurance plans differ from your typical life insurance plan?
Typically people will tend to buy term insurance. So it'll last for 10 or 20 years depending on what the term is, and it may cover, up to your retirement time. You're paying into it. When the time comes that it's done, either you're still alive, in which case, you and the insurance company walk away, or if something happens to you, the insurance company pays out. So once that term is done, the insurance company has no obligation to pay you anything. So it's a bit like your car insurance, right? It expires, you move on, and you get some new insurance. If you get a whole life insurance, it has that same feature, but it also has an investment feature. So what you can do is you can actually pay more into it. It invests within, and it depends whether it's universal or whole life, they have slightly different factors there. But it's invested, and so it's growing, again, tax-free because it's in an insurance contract. So and in fact, you can over-contribute to your insurance, and once you get to retirement, you then have a cash value. Even if you're not paying your premiums anymore for the life insurance portion of it, like if something happens to you, there's a cash value to that contract. And so what happens is it can get to be fairly large. And when you get to retirement, say you have a cash value of $300,000 or $500,000 in it, you can actually borrow against that and use that to fund your retirement. When you finally pass away, that contract, the insurance comes due and it pays off your borrowing, and off you go, it pays the rest to your beneficiaries. So it can be used, and it can be used really effectively in some ways. So here's a chart that really shows how you want to pay yourself tax efficiently as an entrepreneur. So again, to begin with, at the beginning, the purple part there is the dividends that you're being paid, and it's going to be probably the larger portion of how you're being paid out. So to begin with, you want to maybe prioritize your tax-free savings account. Reality is you want to be contributing to it all along. And in fact, I put a line here, but it doesn't have to end once you retire. You can use that as a savings vehicle for you, a tax-efficient one, all the way through your old ages. So it's the one account that doesn't end with any particular timeline. As you start to get more T4 income, you're going to want to start putting more away into your RSP and allowing that to grow. Now, you have another option available to you as an entrepreneur or as someone who has a corporation. So some lawyers can do this and doctors and so on. But you have another feature that you can do that is actually really handy, and that's called an individual pension plan. So what this is, it's like a defined benefit pension plan, which is typically what you get at governments and so on, but it's specifically for you. And if your spouse is getting paid through the company, they can be included on that. And here's how that works. It is typically set up, your sweet spot in terms of starting it is age kind of 45, 50. And what you can do when you start that is you can put more contribution room. It has kind of, you know, at age 50, I would say it actually has double your contribution room compared to your RSP. So you can put more money into it than you would into your RSP. That's a tax-deductible expense to your company. So not only is it planning for your retirement, you're taking care of that end of things, but it also, and this is important as your business becomes more successful and starts to have retained earnings and so on, it's also a really nice vehicle to bring money tax-free from the company into your personal account. And so that's an individual pension plan. It gets a little bit more complicated than that in some ways because you can also pull money from your past service. And so in some cases, you can actually bring a significant amount of money out from your company into this plan. The key is you need to be pretty serious about saving for your retirement, and your company at that point needs to have fairly steady cash flow. So if it's in something that's really cyclical, it may not be the best option for you. Now, this is something that your accountant is going to have an opinion on, and this is, again, one of those times where your financial advisors, and that is to say your accountant and your lawyer and your investment advisor, in this case it's mostly your accountant and your investment advisor who will be talking this through with you as to whether or not it's appropriate for you and whether or not that's something you want to do. Any questions on that? Yes?
Under 35, would you recommend even considering this as an option?
No, there gets to be a sweet spot for it. And it's around the age 45. It doesn't work as well under that. So what you want to do is start out with your RSP. But what happens with the individual pension plan is that you can go back. So if you've been T4ing yourself for the last 10, 15 years, you'll have past service that you can kind of drop into your IPP as a lump sum. So you don't need to rush into it at age kind of 35, but age 45, what you'll be able to do is kind of take advantage of your past service and so on, and be able to drop a really, a nice big lump sum into it. Okay, so risk and reward. Now we get into, so far we've been talking about saving and what to do and where to put those savings, but now what do you do with those savings? So what kind of an investing strategy do you have? As entrepreneurs, you have accepted a lot of risk. That's by nature what you're doing. And for some of you, that may be significant risk. So consider that when you're making your investments. What you could think of is that a huge portion of your investment capital and your efforts are being put into one small cap investment, which is not diversified and it's high risk on the risk spectrum. So what you need to do is look at that and tailor your investment risk appropriately. So what I would say is you need to ratchet it down, and it shouldn't be high. Your investments should not be high risk because your occupation is. This is kind of a difficult concept for entrepreneurs because by nature they tend to be risk tolerant. So they don't want to not be risky necessarily with their investments, but you just need to kind of remind yourself that what you're doing in the big picture of things, like you're investing everything into one micro cap company, which we all know is not the way to invest. So you need to balance it. And so you want to tailor that. And so when we look at asset allocation, we have kind of here, the very basic groups of investors, from conservative investors up to aggressive growth investors. Entrepreneurs tend to be by nature fairly aggressive. And so you're way up here on the risk spectrum. So your investments should not be. They should be down below. And I would suggest, I don't think you need to be totally conservative. I think you can have some exposure to the stock markets, but it should be minimal. And the exposure that you have should be really large cap boring stuff. So, you know, no junior mining plays. not necessarily best for the average person, but that's what I would recommend. So basically, I would suggest you want to be kind of in the income or the balanced area. So I would, you know, I think it is a good idea to have some exposure to equities. It's going to help you fight against inflation. It's going to give you a little bit of growth, but you want to do really, you know, boring large cap, slow growers, and have a good chunk of money in something that's, you know, fixed. So either like bonds, or you may have some preferred shares, but you don't want to be too aggressive in that way. Now, what kind of return can you expect from that? Well, historically, if you're an income investor, you're going to get kind of 4%. A balanced investor is going to get kind of 6%. So I would suggest that's kind of the range that you should wrap your head around in terms of long-term expectations. Now, the good thing is that if your company is going through the ups and downs of the market cycles and so on, and you know you've got this roller coaster, if you do have a good chunk of investments in fixed income, at least you won't see the ups and downs quite as badly with that, and it should at least alleviate that stress that some of the rest of the population is getting. So if we take a look at the market, I threw this in here just because, you know, we do have market exposure, and I'm sure some of you have some exposure in the stock markets, and they've been pretty volatile over the last few years. So I throw this in here just for a little bit of comfort. What we have here are the bull market periods and bear market periods. So bull market is when the market's going up, bear market's when it's going down, and this is since 1956. So what you can see here, a couple of things. First of all, there's a distinct regularity. Usually about 1 out of every 6 years is pretty bad in the stock market. Now we've had a lot of volatility in the last few years, but nonetheless, you know, overall in the last few years, other than, you know, after 2008, 2009, and 2010, we recovered pretty well. Last year was a bit of a mixed bag. So this shows the cyclical nature, and so what we can get from this is that the positive or the bull markets are both longer and higher returns than the bear markets, which tend to last quite a short period of time, and they tend to be less negative than the positiveness of the bull markets. So I just threw that in there because I could. Now we'll change gears a little bit and talk about succession planning. This should be a significant part of your planning, and this is where you can see, again, you've got kind of two groups of people, ones who have planned to succeed out of their business somehow, and those who haven't, and how this can work for them. So first of all, you need to think about this. When are you going to harvest the value from your company? This is not a question that I can answer, and probably even your accountant. It's going to depend a little bit on you. Now, I'm sure some of you are serial entrepreneurs, and you may start up a company. It's really exciting to begin with. You're really revved up on all that excitement, and then it starts to become successful. Things are going well, and you get bored, and you have to move on. So that for you may be a trigger point. Others of you may start a company, you become totally connected with it. It's kind of your baby, and you can't imagine retiring from it ever. So you're going to need to think a little bit about what it is that's going to cause you to decide to leave your company, what those trigger points might be. I know I was walking down the hall in the concourse of my building, and they have a small business which has just started up a cupcake business, and it's been open for, I would say, about 2 months. The lineups are massive. Valentine's Day lineup, you know, they had all the posts set up, and the lineup was down the hallway. And I kind of thought, it seems like a bit of a fad. Things are going really well. I think you should sell now. But that was, I have no idea if that's what they're going to do, but that was my thought. But you need to think a little bit in that way of trigger points and so on. More importantly is who's going to buy it. So you may have a partner. You may have kids who you hope are going to grow up and come into your business. There may be a key employee, or you may hope to make a sale to someone else. You need to think about this a little bit. And the reason for that is you don't want to hit retirement and then find out that you were going to sell it to your key employee, but in the meantime, your key employee was really interested in your company, but decided that this was never going to happen and moved off to something else. So you want to kind of build it all in. So one way of doing it, the bad way, is exactly that. You get to the point where you want to sell and you hope that you're going to find someone to buy it. The second way is to start to dole out share interest to some of your long-term employees or your kids or your partner. You start to dole out some of your share interest, and then at the point when you're ready to retire, that's when you give them the remaining shares and off you go. So you've managed to keep them engaged the whole time and interested, and they can see that it's going to become reality. And that's a much better way of looking at that. And that brings me to the fact that I don't think I talked about shareholders agreements at all, which I was going to do. So I'll just jump at that now. One of the things you want to do is to have a shareholders agreement. That's basically an agreement that you have with either your partner or the major shareholders, and it's there to make sure that you have a protocol that's in place in case something happens and you're not getting along suddenly. And with that, there are a few features you want to make sure you have in that. They typically have a right of first refusal. So, your buddy decides that they want to sell, or your partner decides they want to sell to some other guy down the road and kind of arranges with that. You have the right to jump in and buy them instead of the other person. You have the first right to purchase those. A second feature that they may have is a tag along. So you've got a partner. Your partner decides that they want to sell, then you have the right to sell along with them, and then you both sell and get out. So that's called a tag along. The third one's a drag along. So this one, your partner decides that they want to sell. The person wants to buy the whole company, so they can drag you along and sell your shares as well. Fourth one is an agreement, or in the case of death, then you would have the right to buy their shares, typically over a period of time, like 36 months, at market value. Now, if that's a significant amount, then you have to think, well, how am I going to have the funds to do that? And typically what your advisors would suggest in this case is that you have a buy-sell agreement with insurance in place, so that if something happens to one of the two of you, the insurance will kick in and be able to buy the shares. And that's a really good thing to have in place. And the fifth clause that is kind of typical in a shareholders agreement is the shotgun clause, which is a bit like when you were a kid with your best friend and you had a piece of cake that you wanted to split in two. One of you splits the cake and the other one gets to pick the piece. So this is the same kind of thing with a shotgun clause. One of you decides that the partnership's not working. The other person gets to decide whether they buy it or sell it to you. And that's what happens when things aren't going along so well. So that's just another piece that should be in place as protection for you and your partnership as you go along. And that's kind of the realm of the lawyer. And typically that would be your lawyer kind of figuring things out, and then maybe with different different versions of shares which your accountant would be in on with that conversation. So this brings me again, you want to have a close advisory group. You've got to have an accountant, lawyer, investment advisor. There may be an insurance broker in that, although your investment advisor may be able to do both. But you want to have these people talking to each other. And typically you might have one of them that kind of organizes the group. Anything else on, any questions on succession and planning? You guys are awfully quiet. Retirement. So again, when to retire? Typically people are, and I think there was something in the paper today, typically now people are choosing not to retire at age 65. They're choosing to retire a little later for obvious reasons. The markets have been crazy and people don't feel that they have enough. So what you may choose to do is at some point you may sell your company. You've decided you have enough. You may go and consult back to that company, or you may do some consulting to other companies. But now people's vision of retirement is not that, you know, you finish and you go traveling for a few years and then life goes on. Typically people now do some consulting and part-time work during their retirement and then taper that off. So when you think about retirement, there's a little bit of planning there and a little bit of vision in terms of what you think you're going to be doing. And that, again, is something that you need to think about. And, you know, some people find that they don't have the time, but it's worthwhile putting a little bit of thought that way. And then you need to think about what will fund your retirement. OAS and CPP are a given, but it's only about 17 grand a year. So you're not likely to survive well from that. You're going to need to add to it. So either you've put money into your RSPs or your IPP, or you decide to sell your company. The big problem is if you can't sell your company. If there's no bid, what's the value of your company? Has no value. So if you haven't put any money away for your retirement and you're expecting the sale of your company, you know, you're going to have some trouble. Also, you know, when you sell your company, a lot of the time you have inflated in your mind how much it's worth, and sometimes you can't get what you thought you would be able to. So I would encourage you to put some money aside and not just count on the sale of your company. So how much are you going to need? Again, this is a good situation for your investment advisor to do a little bit of planning and look forward for you. But you need to also think that through, and you want to look at through from the terms of expenses. And typically your expenses may decrease a little bit, but they may not decrease a whole lot, because if you decide that you're going to go traveling, you know, in fact, some people find that they retire and they're actually spending more than they did out of retirement because they're playing a lot of golf and they're traveling. So you need to think about that. Now, just as a rule of thumb, if you figure you might need an extra 50 grand a year on top of the OAS and CPP, and you're going to have a lump sum that is going to generate that 50 grand a year every year, how big does the lump sum need to be? The rule of thumb is it needs to be 20 times bigger than whatever income you're expecting to get out of it. So if you're expecting 50 grand, what kind of a lump sum are you going to need? $1 million bucks. So it's a big number. It sounds ominous, but again, this is why you need to save a little bit, you know, automatically, monthly, and it needs to happen over a long period of time, because otherwise you're going to find, you know, that's when you get the 55-year-old with the $15,000 RSP going, so can you help me? You know, you need to have that savings habit going. And unfortunately, we do see that. So again, you know, going through that again, if you want 100,000, you need 2 million. And that's the importance of trying to put away money into your RSP, and that's where the IPP can come in really handy. So if your company is making a good amount of money, of earnings every year, it's something that can really help fund your retirement.
I just had a question about the IPP. Is it related to the years of employment of yourself with respect to T4ing? So like if your company's been around for 20 years, that's a good thing. But if I created it when I was age 42,
you need to have T4 income.
Right. From the entity in question.
Yes.
Right. Okay.
So you want to have T4 income, and that's part of the reason why you want to have that T4 slip and not just dividend yourself all the time, is to build that that room there. Okay, changing gears again. Let's take a look at managing corporate assets. Now, we're in a period of time with really low interest rates, and they're likely to continue for a while. So are your options really varied in terms of corporate cash? not hugely, but it's still worth talking about. So if you are fortunate enough to get a lump sum to grow your business, that's great. If you don't need to use it right away, then you've got a lump sitting there. What do you do with it? Well, you want it to be liquid and secure, and that is thing number one, right? That's the highest priority. The last thing you want to do is have this lump sum that you're going to use, that you need it for a specific event, 3 months down the road, and suddenly half of it's gone because something happened in the markets and so on. So you need to have it liquid and secure. That's item number one. So you're not going to take any risk with it, and in taking no risk, you're not going to get much return. And that's the reality. So basically, if you've got less than $1 million sitting in the bank, it's probably not even worthwhile pursuing it. You're going to, you can get a savings account at ING or whatever, or wherever, a high rate savings account from your bank. What you need to remember is the banks are not necessarily, they're not incented to give you the best interest rate that's out there. So that's why it can be handy to have an investment advisor for this particular matter as well, because they can shop around for you. Now, in terms of shopping around, what can they get? If it needs to be liquid and secure, you're definitely looking under 2% if you want it to be 100% secure. So, that's unfortunately the reality of it right now. At some point, the rates will start to go up, and you'll be able to get a little bit more. So, if you have less than $1 million, it's probably not worth fussing about it. But if you're dealing with large amounts, then it's worthwhile having someone look around and see what they can get. And we're probably in that low interest rate, I would guess. The governments have kind of said that they're in that kind of a low rate regime probably till 2014. So, it's not going to change in the next little while. So we are coming towards the end, and this brings us to planning for the unexpected. So what happens to your business if something happens to you, or worse, something happens to your partner? And that's when you need to have those shareholder agreements in place, and you need to have insurance in place. Because probably the last thing you want is something happens to your partner, and now you're partnered up with your partner's spouse. And these things have happened. So then you're dealing with an unknown entity, or perhaps it's known. And you need to have insurance for this. The company can pay for it. It's an expense to the company, but you should have life insurance because you are your company's biggest asset. And your biggest asset to yourself is your ability to make a living. So definitely need to protect that, right? You've protected your building, you've protected your vehicles, your property, et cetera, et cetera. So you need to make sure you've protected the people who are vital to your business. Disability insurance is critical. You have a 1 in 8 chance of being disabled at some point during your working life. So that is something that is definitely a must. It may be that you go with a critical illness instead of a disability. But those, you've got some options there, but you definitely need to have something in place. Life insurance, and if you have a key employee that if something happened to your business, you'd really be hooped, you should have insurance on them as well. And then buy-sell agreements, I've talked about a little bit. That's when you have a partner, and it will allow you, if something happens to you or your partner, to allow the other person to buy the shares. Yes?
If you're incorporated, can the business pay for your life and disability?
Yeah, it should all be within the corporation, for sure.
So the beneficiary remains the individual, but the expense is the company?
Yeah, and the beneficiary is probably, it may very well be the company in some cases, because that's who's going to need the money. So for your key employee, for example, the beneficiary would be the company.
But you would say an owner, major shareholder in that context?
Yeah. Okay, and this brings us towards the end here. So I guess what I'm trying to stress from my talk today is that you need to protect yourself, and you need to protect yourself in various ways. So it's either from keeping your expenses separate from your business, both by protecting yourself from the audit of the CRA, or from creditors if something happens to your business. That's one thing. You need to protect yourself from your partners, so make sure you have a shareholders agreement in place, and that will add some protection. If you're incorporated, you've got, again, a layer of protection from the creditors. And then insurance. If something happens to you and you can't work, you need to protect your business in that case. Secondly, be proactive. As you know, from that first slide where the vast majority of people are not prepared, please be proactive and don't just sit there and think, okay, well, they're not doing anything either, so that makes me feel really good for not doing anything. Like, you know, be proactive, do something about it. And if it's just making sure that you have a savings plan in place, something that's kind of pulling money aside. And I know at different times of your life, you know, you talk to the 25-year-old and they're like, well, I've got loans from university. I can't possibly be saving anything. Well, what happens after you get loans from university? Well, suddenly you decide to buy a house, you get married, now you've got kids, you've got a massive mortgage, now your kids are off to university. Like, there's always going to be something. So that, with that in mind, you need to put, you know, that saving strategy in place, and you need to review it and try to increase it kind of annually. Delegate. So make sure that you have in your advisory group an accountant that you trust, an investment advisor that you trust, and a lawyer that you trust, and that these three people are talking to each other. And they'll know who else needs to be kind of brought in at different times, whether it's a, you know, an insurance broker or, you know, what have you. But those three people need to be talking, and those are pieces that, you know, the lawyer is looking at the shareholders agreements and so on. The accountant's going to help you with, you know, setting up holding companies and making sure that the share structure is proper between, you know, is the way it should be. And then your investment advisor is going to make sure that that money is flowing kind of tax efficiently and growing at the rate that you want it to be growing. And then lastly, you need to use the right tools at the right stage of your business and try to be tax efficient that way. So look at the options that are available to you, and it's fairly typical that, you know, I'll go talk to a small business owner and they will never have heard about an individual pension plan. It may not be necessarily the right thing for them, but at least they should know about it, and they should have had the conversation with their accountant as to whether or not it is the right thing. Any questions? Yes.
Can you speak a little bit about the choice between paying out income as dividends versus paying out income as salary by like a T4? Mm-hmm. Like, I'm in control, so I could make a choice either way.
Yeah.
Can you comment on the relative merits of each and the tax implications?
Well, again, so this is, I can talk about it to a certain degree. You want to, you know, the bottom line is going to be your accountant. So, you know, typically the T4, typically at the, well, I mean, what typically happens is at the beginning you're dividending yourself and being paid that way, which is kind of it's a tax efficient way from the way that the company's set up and so on. However, because you're eventually going to need to be saving funds and so on, and putting money into your RSP and maybe an IPP and so on, you don't want that to be the only way that you're paying yourself, because at that point you're not getting a salary and you aren't growing that contribution room. So there's always a bit of a balance, and that again is something you want to keep in mind. So if you're early on, I wouldn't fuss too much about paying yourself by dividend, but you want to probably have at least some T4 income, and you want that to be a growing portion because you're going to need to be able to save for yourself at some point. So it's something that you want to grow through, but to begin with, it's always the most tax efficient way to pay yourself through dividends. Yes.
All right. So follow on to that question. If I've got enough contribution room from previous employment, mm-hmm. would you suggest then to continue paying out by dividend?
I would say that to begin with, it's not a bad way to go, but at some point, again, you want to be making, well, I guess you want to be making, it depends on how much money you're making and whether or not you've got money to be putting away. So at some point, you want to be taking advantage of that room and still creating more. So you need to have a bit of a balance there. but if it's early on, I wouldn't fuss about it, but it is something that you don't want to be doing the whole time. You do want to have that taper off and be able to contribute and grow. And again, like, we're kind of in the gray area where those kinds of questions should go to your accountant as well. And that's kind of their area of expertise. Yeah.
Can you talk about emergency funds?
Oh, emergency funds.
How big, how to make proper decisions regarding their management?
Okay. I can talk about emergency funds from the perspective of your personal finances. I'm not, in terms of your business, I would need to know more about your business. From your personal perspective, typically, a planner will suggest that you want to have enough funds to be able to cover 4 months of living, or up to 6 months of your basic living amount. So some people will put that money aside, and if you're, I guess if you're in an entrepreneurial situation where your company may not make it, it probably is not a bad idea to have that money actually set aside. For someone who's in a more secure situation, I have also, suggested just having a line of credit that's available to them if that happens. Having said that, again, if you're in a risky venture, then you need to always err on the cautious side with your personal finances, and you probably want to actually have that amount set aside in something that is fairly liquid and so on.
So like a high interest savings account would be appropriate.
A high interest savings account, or if you could even maybe think of a bond fund if it's sitting there and you don't think it's that likely, but you probably don't want to go more risky than that. Yeah.
Yeah, in the early days when you're still building the business and
Mm-hmm.
there isn't a lot yet to invest. On one of your earlier slides, you had a comment about let's see, advice-based fees
Mm-hmm.
and versus sort of transaction-based for investment advice.
Mm-hmm. Mm-hmm.
In Canada, what's been the trend around sort of advice-based fees? Is that something that's appropriate for an entrepreneur who's sort of starting in?
So typically with your investing accounts, your advisor may have a couple of different ways. So you can do kind of the old-fashioned commission-based, which is transactional, or you can do a fee-based account, which is a percentage. Now, it's going to depend. Each advisor basically gets to plan their own business, and so they can charge, a variety of amounts and so on. I will offer both to my clients, and I typically try to make it so that my asset-based fees are similar to what the traditional based fees, which is a commission, would be. So often there's not necessarily much of a difference, but you want to look around. And I guess on the topic of fees, I wouldn't want to be paying more than 2%. So for example, if you've got a purely mutual fund portfolio, you may already be paying kind of more than 2%. I try to keep that. I'm pretty aware of fees, and I think that a person really shouldn't be paying more than 2% on an account. Now, if your account is mostly fixed income, which is what I recommend with you being high risk and so on, then they could be even lower than that, down towards probably just over 1% or 1.25% or so on. So you would expect, because you don't have to make as many decisions if it's fixed income, you would expect the fees to be lower. Yes.
With regards to personal finances and the saving 10%, if you get into a scenario, say where you're at the end of the month, you're looking at the books, you've made your maximum RSP contribution for that whatever time period we're talking about, and you've met all your minimum financial obligations, and you've got this theoretical 10% left over. Are you saying it's better to actually put that aside and say one of these interest-free savings accounts, or if you're carrying some debt that's at say 8 or 9%, the math to me seems like you would pay down the debt, but it sounds like you're saying you should always be putting something aside.
Well, I believe that saving is a habit. So if you have debt and it's at 8 or 9%, I would say for sure pay it off and put the money towards that. However, I think that at the very least, if you're carrying a lot of debt, you should still be saving some money. And the reason for that is that it is a habit, and if you break the habit and suddenly you're not putting money aside, it's much harder to kind of start that again. So even if it's a nominal amount, like I've even suggested some people, you know, put $100 a month away, or you know, $50, whatever you can afford that's at least putting something away, and then try to increase it. But if you're paying, you know, if you're carrying a heavy debt load like that, I would still put money into your RSP, because that's, you know, it's for the future and you need to try to do that. But certainly pay down anything that's that high. My tongue is apparently not working so well. Yes?
You talked at the beginning about holding companies.
Yeah.
How does that work exactly?
Okay. Again, this is kind of a grayish area for me, and it's kind of more in the realm of your lawyer and your accountant. But holding companies basically act for a couple of different reasons. First of all, you've got your operating company that's making money, and it's got money coming in and out to pay the bills and run the company. The holding company is a company that's between that and you. So again, you're getting an extra layer of protection from creditors and so on. But what you'll have is money that's not being used for the business can be put into the holding company, and then you pay yourself from there. And you can maintain funds in that. And in fact, if your operating company suddenly needs more and you've got it in your holding company, you can move the funds back. And that is really tax efficient. You're not being taxed between corporations that way. I mean, I guess you've got the added corporation, so there's always an expense and so on to get these things set up. But it can be useful that way. And it's a nice way to maintain funds that are kind of within the company, but they're being held separately. They're not being used to run the day-to-day operation of the company, and they can just grow there. And so that becomes a challenge, you know, if you're successful and you get towards retirement and you're thinking, well, how can I get these funds out into my, you know, personal wealth and do it in a tax-efficient way? And that's where having something like an individual pension plan can pull out a lump like that in a tax-efficient way. And that's kind of the challenge as you become successful. More details, like if you want to know the actual details of the workings and so on, you need to ask your accountant and lawyer as to when is the best time and so on. Yes?
If your company is paying you as an employee, say $10,000 a month or whatever it is, what's the best way to actually pay the various income tax on that? Like, you know, would you as the individual put that aside, or is it better for the company to actually pay that and take it out?
I think it's, in some ways it's nice for it to be taken at source, and then you don't have to worry about, you know, having to pull together a lump sum, you know, when it comes time for installments or at the end of the year. So I would say, and it's, again, this is a personal preference, I would prefer to have it taken off at source, but not, you know, you always want to try not to have so much taken off that you're going to get a big refund, because now you're just giving the government a tax-free loan for a period of time. So you want to try to balance that out. But I think it's kind of handy from that perspective to have it taken off at source, but it is pretty well a personal preference in that way.
Would the most financially min-max thing to do would actually be to hold on to it into a savings account and then pay it at tax time?
You could do that. If you know, it takes the discipline. So if you've got the discipline, you could do it.
Doesn't this run you afoul of like various installment rules with respect to CRA anyway, though?
Well, I mean, certainly if you're pulling enough that they want installments, then you have to.
They're wise to that, so you'll have to pay probably at some scale anyway.
Yeah, if it's a big enough lump sum, then that's what they're going to do. If it's not, then you could certainly do that, but. They're tricky, those CRA guys. Yeah.
You mentioned succession planning earlier. You've got your advisory group. Chances are they're not necessarily specialists in succession. Is there specialists specifically for succession?
There are. Now, if you have, if you're investment advisors with a big company, they probably have guys, like they've got a battalion of guys behind them. So if you've got a company that you're working through the succession planning, there's probably a battalion behind your investment advisor that they can tap in on to work you through that. And that's why people typically think lawyer and accountant, and that's what you need. But you know, if you've got an investment advisor at a big company like mine, you know, you've got a huge bunch of people who are, you know, can deal with massive, you know, complicated tax issues or estate planning or succession planning. So that's kind of an advantage to having that. Yeah.
Can you comment on paying family members and things like that, ins and outs of that?
So if you've got a spouse who is in the company, and again, you know, I can talk a little bit about it. First of all, if you have a spouse, it's not a bad thing to have them on the payroll because, again, with something like the IPP, they can be included in that individual pension plan. So there are advantages to doing that, and that's one of those advantages. Other than that, I don't know if you've got anything more specific.
I was thinking more like things like income splitting, where if you're making with your spouse, you can sort of work it so that you're sort of minimizing like household net tax.
Yeah, you can do that, and certainly, so some people will do that, and also take advantage of things like spousal RSPs, where if you're making a significant amount more than your spouse, then you may be wanting to contribute to their RSP instead of your own. In which case, come retirement time, you're going to probably even out a little bit in terms of RSPs and so on, and pay tax less at that point. But you can be paying for that. So those are certainly options that are available to you. The government seems to be moving towards being more easygoing in terms of income splitting or differences between spouses, and looking more at household income rather than personal, especially when it's coming towards retirement. But nonetheless, there are still options like that in terms of contributing to your spouse's RSP, and also you can do loans between spouses. So if you've got one person who's got assets and the other person doesn't have much income, you may want to make a loan to them. And right now the interest rate's 1%. Now you have to show that interest. You have to show that the money's going over here and the interest is coming back. But then what your spouse can do with, say you've got, I don't know, you loan your spouse $100,000, they pay you 1% interest, they can go and invest that, and any income on that investment is taxed to them rather than you. So there are options like that. Anything else? Yes. Sorry.
Further to the spousal employee business, what, I mean, is it enough just to put it on paper and say this is
That's a good question for your accountant.
Okay, all right.
So I mean, obviously they should be doing something. If the CRA audits you, I'm sure they're going to want to see that they were doing something, but I know that this is a gray zone in that way. But I would not want to be the one to give you advice on that.
Laundry and dinners.
Exactly.
Any particularly good books on sort of entrepreneurial finance for Canadians?
I would have to look into that for you.
Okay, just curious if
I can't think of one offhand, but I can look around and see if there is one that catches my eye in terms of in that sense. I'd have to get back to you on that.
Thanks. I'm seeing a business opportunity for you.
Yeah, maybe.
Any other questions? Well, thanks very much, Zoe. I think that was really informative.
Oh, good. Well, thank you. Hopefully.